Melissadunn here with the Melissadunn Realty team. I am joined today by our preferred lender, Brandon Hern. We are in our lender series. This is video number 3, and we are going to talk about a really brief kind of overview on some of the more popular loan programs available that a lot of my buyers choose, and I think a lot of Brandon's clients choose. So, Brandon, how are you today?
Good, doing awesome.
Great. Okay, so let's jump right into the questions. So the first loan that I want to talk about is the conventional 20% down mortgage. Who is that for? What are some of the qualifications? What can you tell us about the 20% down conventional loan?
Yeah, so the conventional 20% down loan is kind of the gold standard, right? In fact, there's a lot of people that believe you got to have 20% to buy a house. That is not true. You can put down a lot less than 20%. But 20% is the gold standard because that allows you to get the lowest interest rate available in the market for your credit score, and you don't have to pay any sort of private mortgage insurance. So private mortgage insurance is a supplemental insurance that the bank requires to be a part of your monthly payment if you put down less than 20%. So you can save a lot of money monthly, and you're going to save a lot of money in interest. 20% down loans are generally, like me, for example, I didn't have 20% to put down on my house. I didn't have that until I sold my first house, took all that equity, right? All that equity that I earned because I was lucky that I lived in North Texas, and put it down 20% down on my next one. And so my next home was more expensive, but my monthly payment was less than my smaller house because I didn't have mortgage insurance. My rate was lower and I had a lower loan amount. So it was awesome.
Okay. Very good. Okay, so what about the conventional 3% option? Tell us about that.
So conventional loans go all the way down to 3%, right? And it's a scale. So you can put down as little as 3%, and then the next hurdle is 5, and then 10, and then 15, and then 20. Okay, so they go in sets of 5, but now there's a 3% down option. And there's a couple different 3% down options. There's one that's income-based. This is one that says if your household income is this amount or less, then you qualify. And the reason why I keep that vague is because the income amount changes depending upon what zip code you're buying a house in. Mm-hmm. And sometimes you could look at a house on that side of the street and you'd qualify for the income-based one, but on that side of the street you wouldn't because of the way the street and the zip codes line up. So it's really important that your lender explains these things to you. So there's an income-based one, and there's also a property-specific one. So some properties, again, regardless of your income, you qualify for it because that property is declared eligible for 3%. And other properties, now, they're not just blanket eligible. You have to income qualify. And then you have a 3% down product that anyone can use as long as they're a first-time home buyer. So there's a first-time home buyer 3% down one, not income, not property, but you have to be a first-time home buyer.
Okay, very good. Yeah. Okay, what about the FHA 3.5% down?
So FHA 3.5 is your traditional first-time home buyer loan. The 3% down conventional is a pretty new product. Came out in the last year or two, and it came out to compete with this one, the FHA one, right? I like this one because it's been around a long time. People are familiar with it. I used it. There are pros and cons to it. Again, low interest rate, it's subsidized. That's awesome. The con here, low interest rate's a pro, low down payment's a pro, 3.5%. The con is that your mortgage insurance, you pay 2 types of mortgage insurance. You pay an upfront, which gets wrapped into the loan, so they allow you to borrow it, and then you pay it monthly. So what I tell people in this option is it's a phenomenal option to get you in a house. You get in about 1 or 2 years, maybe 3 years. If you're still living in it, you probably want to refinance out of the FHA into a conventional, right? It's a great product to get you in a house. The lender can pay a lot of your closing costs for you, so you don't have to come out of pocket for closing costs. It's a great program, but you do give up some of your equity in the mortgage insurance premium, and your monthly payment has mortgage insurance in it. So you just kind of got to be aware of that. But you're going to get a lot of your closing costs paid for, and you got a low down payment there.
Awesome. Okay. What about a USDA loan? What is a USDA loan, and where can you use it?
All right, USDA. That's an interesting loan. So I tell people, I try to keep it simple. If you're going to buy a house that's not in a city that a normal person has heard of, it may be in a USDA area. Okay. So USDA is a rural development loan. The whole purpose of it is to get people to move into areas where they wouldn't normally move.
Yeah.
Right. It's 100% financing. In fact, it's 102% financing sometimes, which means you can finance not just the price of the house, but all the closing costs as well. It's a great product. There is income eligibility and there's property eligibility. So if you go to the USDA.gov website, there's a little button, you can click calculator, and they'll ask you a bunch of questions about your income and tell you whether or not you're eligible. They'll ask you a lot of questions about the property, and you can look at a map, almost like a Google map, type in the area, and it'll tell you if it's eligible or not. In North Texas, right now, in kind of our inside the circle of the Metroplex, very few areas would be eligible for that. You kind of have to go outside a little further.
Yeah.
Great product though.
I think I know Lavon is still USDA, right? Lavon is still USDA, which is near Wiley. I think maybe Aubrey is still. I don't know. Have to go on the website and freshen up.
Here's the other thing to note about USDA. It's very important. So the USDA is the only loan of all these loans we talk about that the USDA requires that they underwrite it.
Oh.
So conventional loans, we can underwrite in-house. I can close it in 15 days, 10 days if I had to. FHA, I can underwrite in-house. We're endorsed by them. VA, we can underwrite in-house. USDA, got to send out. USDA doesn't allow that. What does that mean for you? That means that the USDA takes about 2 months to close the deal. So in a super competitive market, the USDA loan may prevent you from winning a deal.
Yeah.
May. Won't always. So what I tell my clients who do USDA, I say, listen, your plan is to win the deal with a USDA loan. But if you have to have the house, if you got to win the deal, are you prepared to switch it to a different loan?
Mm-hmm.
Because if the seller comes back and says, we love your offer, but we got to close in 3 weeks to take it, are you going to switch? If the answer is no, that's okay. Just be aware that the length of time for USDA to close may prevent you from winning the deal.
Okay, good point. What about a VA? This is our last loan type. What about a VA loan? What is it and who is it for?
So the VA loan is my favorite, clearly.
Mm-hmm.
I got to use it. It is the best loan. So the VA loan is 100% financing as well. The interest rate is subsidized, so it's going to be the lowest rate out there in the marketplace. You're not going to pay any mortgage insurance. So the VA insures the loan itself. It's phenomenal. The only reason anyone gets caught on VA loans is because the VA loan is such a great loan. It's such a good deal that they're very particular on income. So if you're a self-employed borrower and you're trying to do a VA loan, you're going to want to call your loan officer like yesterday, because there's a lot of rules that the VA has. They're very particular on that other loans don't have. So the VA loan's a phenomenal loan. Some lenders cannot do VA loans very well because they're not directly endorsed by the VA. Mm-hmm. So if you're a veteran and you're going to do a VA loan, you're going to want to make sure that that lender you talk to has a direct endorsement. The VA underwriter is in the office with them, not at some call center in California, but physically in the office. And if they have that, you'll be okay. Be in good hands.
And who all can use a VA loan? I don't know if we.
I didn't even answer that question. So veterans, active duty service members. So the VA has what we call a COE, which is a certificate of eligibility. And their guidelines to receive that can be found on their website. But if you served in the military, or you're currently serving and you're in good standing, or you're honorably discharged, you should be okay.
Okay.
If you're curious, and veterans would know this, you can go on eBenefits, ebenefits.gov, and you can apply for your own COE.
Very good. Okay. Well, Brandon, thank you for all of that knowledge. We appreciate it, and we will catch you back at video number 4. Okay.
Thanks, Melissa.